Most financial advice on the internet suggests you should invest like Warren Buffett. He is the grandfather of modern finance, famous for buying massive blue-chip companies and holding them for decades. This chart shows the growth of a mature, multi-billion-dollar portfolio. When you manage a fund of that size, your percentage returns are often low. Mimicking a strategy designed to protect $100 billion when you only have 5,000 is a mathematical dead end. But his performance in his 20s tells a different story. When he was managing smaller sums, his wealth grew at a rate that today's Berkshire Hathaway simply cannot match. To reach your first million, you have to ignore the 90-something billionaire and study this kid. He succeeded by exploiting market advantages that were uniquely available to the small investor. Reaching 7 figures early requires a strategy that billionaires are actually locked out of. Having a tiny account wasn't his disadvantage, it was his greatest asset. Zero capital yields zero compounding. Before he could buy his first stock, Buffett used high-volume arbitrage to build his seed money, selling packs of chewing gum and Coca-Cola door-to-door for a 2-cent profit. By age 14, he was running multiple newspaper routes, earning enough to file his first tax return. He was taking home $175 a month at a time when the average adult engineer earned roughly $390. He scaled this income using a broken $25 pinball machine. He paid a friend to fix it and placed it in a local barbershop, splitting the revenue with the owner. Every dollar that machine earned was immediately used to buy another, building a network of machines across the city. This relentless cycle of generating seed capital through labor and rolling it into cash-flowing assets created the momentum he needed to enter the stock market. Once he had a small pile of cash, he went hunting for an informational edge. He spent his time in libraries, mining obscure data from the Moody's manuals and pink sheets, looking for forgotten companies that the larger market had ignored. He was applying a concept from his mentor, Benjamin Graham, known as cigar-butt investing. The goal was to find a soggy, unloved business trading for less than its liquidation value, a company that still had one free puff of profit left in it. His investment in the Sanborn Map Company is the perfect example. They cataloged structural data for insurance firms, tracking fire hydrants and water mains in cities across America. The map business was struggling, pushing its stock price to $45 a share. But its balance sheet held $65 per share in blue-chip securities. You were getting the business for free, plus a $20 discount on the cash. To unlock that value, Buffett and his partners would buy a controlling interest in these tiny companies. Once they held the votes, they could force the business to sell off its hidden assets and pay out the proceeds to shareholders. These hidden gems were too small for major Wall Street funds to notice. Finding them required manual research that most investors weren't willing to do, making it a powerful strategy for a small, active account. The final multiplier in his strategy was leverage. At age 25, he formed an investment partnership to manage the capital of family and friends. He set strict rules for his partners. They could only withdraw money once a year, and he maintained absolute secrecy about his portfolio. This prevented anyone from bidding up the prices of the small companies he was targeting. His fee structure was designed for rapid growth. He guaranteed his partners a 6% return, and in exchange, he took 25% of all profits above that threshold. He had no personal downside risk, but his upside was tied directly to his performance. By stacking high-yield anomalies on top of partnership fees and personal savings, Buffett built a system that accelerated his capital growth far beyond the reach of a solo investor. In 1962, Buffett merged his various partnerships. His personal interest in the new entity was worth over $1 million. He was 31 years old. But this milestone made his original strategy obsolete. His portfolio had become too large to buy tiny, forgotten companies without moving the entire market. The cigar-butt era was over. This forced a shift in his philosophy. With the help of Charlie Munger, he moved away from hunting for mediocre bargains and toward buying great companies at fair prices. This pivot allowed Berkshire Hathaway to scale to its current size, turning Buffett into the icon of passive, long-term investing we recognize today. The strategy needed to build wealth from zero is different from the one needed to manage $1 billion. If you have a small account, stop trying to act like a billionaire and start exploiting your ability to go where the big money can't.